Hi guys. Can we start or should we wait for 5 more minutes? Correct, Anumay. So should we wait for 5 more minutes for everybody to return back? Or can we start right now? Hello. Okay. Can we start now? It's 10:33 already. Yeah. Okay. So this is the second session on credit strategy and portfolio management, where we talk about formulating a credit policy. The process begins by understanding the objective established for the credit department. It recognizes the importance of consistency in the decision making. It must take into account the resources and resource constraints facing the credit department. It should make allowances for scenarios in which flexibility in credit decision would be desirable. So there are 3-4 factors which we take care while formulating a credit policy. The first one which is being said here is objectives. So what is my objective, right? The first objective is what? For a business enterprise, what could be the objective in lending business? What could be the objective in lending business? So business with risk appetite, can I write profit? Can I write profit? That is the first motto. See, that is something which we do. Minimum risk, a trade-off between risk and the profit is something which we do. But when I talk about objective, what is my main objective? I got into a business. What is the main objective of a business? What is the main objective of a business? Profit, right? So profit is the main objective of a business. We can say that. What could be the other objective of a lending business? From the lending perspective, what could be other? What else can be there? Least default, if it is there, obviously it will have a positive impact on the profitability. Again, to make money was okay. Sound risk management is again a means to achieve the objective. So there could be two reasons. One is profit, another is social development. So there are certain finance companies, especially microfinance institutes, MFIs. What they are doing, they are funding in rural areas on a JLG model. So when I say JLG means joint liability group. Any idea about JLG? Anybody knows what is JLG? Any idea and how JLG funding takes place? Okay. Correct, Tathagata. Group of people taken together. So JLG means, as per laid down norms by RBI, minimum 4 people has to be there. Right? Minimum 4 people is needed for a JLG bank. Yeah, Bandhan Bank is into JLG. There are other lot of microfinance institutes who are into JLG. Right? So minimum 4 people has to be there in a JLG group, right? So it is a funding in the overall group. Say you give a funding of 1 lakh, which will be distributed among 4 people. Now you can say that how a combined underwriting takes place. Combined underwriting takes place by individual underwriting and the group underwriting, right? So when during collection, typically collection happens weekly or monthly, the collection executive comes, he meets only one person in the group and collects the entire money, which is to be collectible for that particular, installment. And he will meet only a single person who will deposit money for all the other JLG papers. So it is mainly for rural industries, cottage industries, anything like could be for farm loans, could be it could be crop loans, right? Based on that. So this is a social upliftment, but does social upliftment or social development means that the company will run in loss? Can a microfinance company run in loss with social development objective? No, obviously not, right? They cannot sustain with loss. So they have to make money. They have to make profit, and simultaneously, the objective is social development. Now, something called PSL. How many of you have heard the term? Priority sector lending. Anybody has heard this term? Priority sector lending. What is PSL? What is PSL? What is priority sector lending? What is priority sector lending? Any idea? That's okay, like the name suggests, but people should come out with a concrete definition or at least the idea. Some sector, actually the term priority sector lending means to give the facility of banking. It can be both from the asset and liability side. That means from including lending, including borrowing to the unbanked class of the country. Now, what is unbanked class? Yes, Kunal. RBI has mandated for every bank to have a certain portion of their portfolio to be going to the priority sector. Absolutely true. Right? Now, what we mean by unbanked class of the country? Who are unbanked? Correct. So rural areas, they have never done any banking activity. So they have never had a bank account or banking habit. They never had a banking habit, right? To cater to their needs, probably opening up an account at 500 rupees and no maintenance charges, and also giving loans to them who has never done any banking activity, has never gone to any bank, doesn't have a checkbook, they don't know ABCD of the banking system. Jan Dhan Yojana, yeah, kind of. So, and especially this class is economically backward class. So if you take a rural belt of Jharkhand who has never been to bank, so you set up a small bank over there or at least a kiosk over there and educate them about the benefits of banking, having a bank account. And also educate them that yes, they are into farming and they can get Krishi loan or agricultural loan, which they can further use for take a benefit for their livelihood. They can earn their livelihood. They can set up a small cottage industry which can help them run their livelihood properly, smoothly, right? So this is the PSL. Now Government of India and RBI has mandated PSL target for all the banks. So what they are doing, regional rural banks. Okay, RRB is regional rural bank, Ashutosh, right? You mean regional rural bank, is it? Right. So these are different types. Like one of the important factor is one of the important component of this entire system is NABARD, right? NABARD. So it provides guidance, it provides banking facilities, a lot of things, right? So plus there are a lot of private microfinance institutes which has come up with this idea of lending small ticket size loans to the backward class, right? So what is happening is, what I was saying is, understand the objectives. What is my objective that I have to understand? That one is profit, another is my social development objective. Second is, it recognizes its importance of consistency in decision-making process. Now what happens? When we talk about consistency, how consistency is important, I started with an objective of social development, right? That I will go to rural areas and fund crop loans. Crop loan. Now I had been continuing doing it for 1 year. Then all of a sudden I decide No, let me stop this and let me go to the urban and cities. Let me go to the urban or cities and start funding of home loan or car loan. So do you think there is a consistency on the approach? There is no consistency in my approach. When I started with an objective. I got deviated from it. Now, the next point is, when you deviate from such strategy, you have to realign the entire workforce, because the type of resource, the type of entire system and process you need for micro loans in the rural belt is absolutely different from what you need for giving home loans in an urban belt. So if you are giving home loans in cities like Delhi, Mumbai, Chennai, Bangalore, Kolkata, Hyderabad, right, then obviously you need a different set of resources, which is absolutely different from the people who are moving in bike to the rural areas and serving and giving loans for crop purpose, cultivation loans, right? Then you have to realign the entire resources, realign the entire systems. You might have to close certain branches which are slightly in the off-site location, and then you have to open branches in cities. Where is the consistency? There is no consistency, right? So that there has to be a proper, coming to credit policy. Do you think that, say, for crop loan, you have designed a credit policy, right? Do you think this credit policy will be similar to a car loan credit policy? It will not be, right? It will not be similar. It will be different. A car loan credit policy will be different from crop loan credit policy. Correct? So consistency is important while formulating a credit policy. Next, it must take into account the resource and the resource constraint facing the credit department. Now, this is very important. Kind of resource you need in the credit department. Now, there is something called corporate underwriter, something called retail underwriter, retail or small ticket size underwriters. Underwriter. What is the basic difference between these two? What is the basic difference between a corporate underwriter, corporate loan underwriter, and a small ticket size loan underwriter? What is the basic difference? So one is target customers, but I'm talking about underwriter, because the third point talks about credit resources. So when I'm talking about underwriter, obviously your target customers changes. And because your target customer changes, so your way of looking at a case changes, right? Now, how does it matter? Correct. In large ticket size, amount of work is always more. That is true. That doesn't mean the amount of work is less in low ticket size cases. Probably the type of work differs. So due diligence, I'll tell you one thing. For an example, when you underwrite a 2 CR proposal, right? What you look at, these two are common. Then you do FI, RCO, then you check ITR, GST, financials, ratios. You might check DSCR. You remember DSCR we talked about in the first session, financial statement analysis. You talk about interest coverage ratio. You talk about the deployment of proposed asset or end use of fund. What else? Work in hand, future cash flows. Okay, alternate data, triangulation, credit rating, right? Do you check all this, right? And probably something else, right? If it is a holding company, if it is a listed company, a lot of things, valuation ratios, this, that, all these things will come up, right? Yes or no? Yes or no? For a 2 crore proposal, right? So all these things will come. You will get into a model, you will see project viability, these, that, everything. But suppose a 25K proposal comes, small ticket size loan, farm loan, crop loan. What you will look at? You will look at you will look at bureau. You will take reference, take local reference. Yeah, KYC naturally bureau. KYC is needed for bureau. Take local reference. Understand the cash flow of the business. Understand the cash flow. Obviously, even a small business, a small activity has certain cash flow which you need to understand. Understand the business model. Understand the business model, right? And you probably go ahead. If you more things, you probably go ahead. Now here, in the proposal of 25,000, do you extract ratios, DSCR, this, that, working capital cycle gap, and what do you say, like triangulation, GSTR? Do you do that? Do we do that? We don't do, because those doesn't exist even, and that doesn't make sense for this kind of profile. So now I have seen in my practical life, in my professional life, I have seen people who has been doing retail or credit underwriting is all of a sudden, if they are asked to do a credit underwriting for a big ticket size loan, they struggle to do that. And similarly, the person who has been doing corporate underwriting, if he is asked to do a retail underwriting of say around 50,000 loan, they'll try to find out financials, DSCR and ratios for a farmer. And this is not a joke. It has happened. One of my boss was throughout, he had been into corporate financing. Then he was asked to handle retail financing. The kind of query he used to raise was, like he became a laughing stock. He used to ask for a DSCR for a farmer. Can you find out DSCR for a farmer? And also a small scale farmer. He used to find out those ratios. He used to ask for balance sheet for a 25,000 loan. So that's why your resources, the third point talks about the resource constraint and the resources in the credit department. Very important. So you are talking about industry. I'm talking about a case, Abhijit. I'm talking about a case. What ratio you will find out for a farmer? Does a farmer, a small scale farmer, they do maintain balance sheets? right? It should make allowance for scenarios in which flexibility in credit decision making would be desirable. Now, again, when we talk about flexibility, what kind of flexibility am I talking about? When I talk about flexibility, what kind of flexibility am I talking about? Correct. This can be a flexibility up to 10 lakhs, no financials required, and hence no ratios except viability. True, very good. This is one flexibility. Second, say up to 2 lakhs, no collateral is needed. Say up to 2 lakhs, no collateral needed. Right? Can be a flexibility. Next, structured repayment based on seasonality of business. Can be a flexibility. Yes or no? Next, I am a customer who is an FTU. I'm an FTU customer. How to fund him? Take guarantee of an experienced person with good repayment and go ahead. Is it a flexibility? Isn't it a flexibility? An FTU customer who has never used an asset, you take a guarantee of an experienced person who has been using an asset or a machinery or a commercial vehicle with a good repayment and go ahead. Go ahead for funding. Is this a flexibility or not? Tell me. Yeah. It's a flexibility, right? So these are the flexibilities we are talking about, right? So a credit policy should not be extremely stringent, then you won't be able to do business. On the other hand, a credit policy should not be very lenient that your portfolio becomes full of delinquencies. So you have to keep a balance when you formulate a strategy or a policy, right? So this is how overall credit policy and the activity works. So on one side, there is customer. On another side, there is company or the banks. They give credit period with terms and conditions. And the credit policy is the set of principles that guides how the credits are given, right? On what condition the credits are to be given. Now, for an example, I set up a policy, no credit or loan to FTU without a guarantor with excellent repayment. Even if I am going ahead with excellent repayment guarantor, then LTV to be restricted to 75%. tenor max say 36 months, moratorium max 30 days, and ROI minimum 18%. These are my credit policy. Apart from KYC, obviously there will be KYC, dedupe, stability norms, income, and other norms to be made. Right? This is something I have formulated a strategy to give credit to an FTU or FTB. Right? FTU or FTB. Next is, can this strategy be similar to a strategic or super strategic customer? FTB is first time buyer. FTB is first time buyer. Okay, and FTU is first time user. So now my point is, this is my credit policy. For whom? For my FTU, FTB customers. Now, can the same credit policy be applicable to strategic or super strategic customer? If I want to do that, they will say, boss, go away. There are other banks in the market. I have to be lenient. I have to be flexible. In that case, what will happen? These terms and conditions changes. My LTV has to be 90%. Tenor could be up to 60 months. Moratorium could be up to 60 days. And instead of 18%, it could be 15%. My conditions, norms changes, right? And once the norms changes, I execute those norms and my operational activity becomes according to my norms, which is preset. My operational activity becomes absolutely as per my preset norms. So when I say a maximum, you understand moratorium, right? Guys, anybody who doesn't understand moratorium, what is moratorium? Anybody who doesn't understand what is moratorium? Okay, so I assume everybody understands what is moratorium, right? Now, my point is, moratorium is basically the difference in days between the disbursement date and first EMI date. This is the moratorium, right? Credit free period, no, it's credit free. You cannot say credit free. Interest is charged on moratorium. Remember this thing. The day you disburse the money, interest gets charged. But yes, that interest is clubbed up in the first EMI. So you might have heard about a term called broken period interest. Have you heard a term called broken period interest, BPI? What is broken period interest? You know that? What is broken period interest? Any idea? So Kunal, can you throw some light on this? What is broken period interest? No, that is not broken period interest. Okay. No, no, I'm asking for loans. What Kunal has said, take second, just a second. Interest for the period between disbursement day and first EMI day. Yeah, this you can say a broken period interest. I'm so sorry. Correct. So now, for an example, I have to give a moratorium of 30 days. Of 30 days, right? I have due dates on 1st, 5th, 10th, and 15th. My disbursement date is 25th of June. So when would be my first? So when is my first EMI going to get hit? I have a moratorium of 30 days. When is my first EMI going to get hit? When is my first EMI going to get hit? But 25th, I don't have a due date on 25th, right? I don't have a due date on 25th. I have mentioned this. These are my due date cycles. 1st of August, right? So my first EMI date, because I have to anyhow give 30 days moratorium. First EMI date is 1st of August, right? Tanumay, what you are writing? 1st July to 25th June. Correct. So 1st of August, so if EMI is there, that is equated, equated monthly installment, then where from my interest should start getting calculated? It is from 1st of August till last day of August. Sorry, 1st of July. 1st of July till last day of July. My interest will get calculated. Right? Yes or no? Sorry, 1st of June. 1st of July till last date of. So that is for 30 days. 30 days or 1 month. Now I have disbursed the money on 25th of June. What about that gap period? 25th June to 30th of June. This interest for 5 days, 25th, 26th, 27th, 28th, 29th, 30. So it is 6 days. 6 days. We have to collect an interest for this, right? So 25th also, so it depends. There are multiple patterns where inclusive of the date, inclusive and exclusive concepts are there. So there is a concept of inclusive and exclusive. So whatever process you follow, if you follow inclusive process, then you are going to add 25th also and probably 1st also. or else you will calculate from 25th to 1st, or you will calculate the dates between 25th and 1st. So in that case, it will be 5, right? So it depends on what policy, what accounting method you follow, your company follows. And accordingly, you set that norms in the loan, LOS, and it gets calculated, right? So this 6 days interest is called broken period interest. So 1st of July, you can calculate from 1st of July till 31st of July. And then you charge that interest in along with the principal with 1st of August. But what about these 6 days? What about these 6 days? What about the interest for these 6 days? This 6 days interest, we call it as broken period interest or BPI, right? So if anybody has taken home loan or car loan, you might have seen a small amount of a check of a small amount. Say they tell it that it's a broken period interest which I'm going to take. They take it different form in the form of a check which they deposit and recover the broken period interest. In case your disbursement date is different from the due date cycle, right? Understood up to this much? So now these are the norms which you said, which guides the entire, underwriting and the credit policy. That yes, I will adhere to this and I'll make sure there is no variance or minimum variance from the preset policies. Okay. Yes, Deepak. Interest is collected. True. Interest is definitely collected. But what you cannot do is capitalization of interest. Can you do capitalization of interest as per RBI norms? Any idea what is capitalization of interest? Anyone? Any idea about capitalization of interest? Correct. Add it to loan value and then further calculate interest on that. Add it to the principal amount and further calculate interest on that. If that is something which is not allowed. Well, I'll not say it's restructure type. It's not restructure type. Correct. This is charging interest on interest, which is strictly no by RBI. Not good for customer. Definitely, it's not good for customer, and also it is against RBI laid down norms. It is against the norms of RBI, the laid down norms of RBI. These are few parameters of credit policy. Just quickly go through this, then we will discuss one by one. Few parameters of credit policy. Please quickly go through this. So the first point is credit department's mission statement. As I had already discussed that what is the objective and mission statement, that I want to do this, right? And it can also be a mission statement like we want to say a book size could be a mission statement like this. A book size of INR 4,000 CR by the end of financial year 2025 with an NPA percentage of 0.5%. Mission statement, right? And accordingly, I will make my credit policies. I will make my monitoring process. I'll design the entire procedure, entire flow accordingly, right? Then the credit application process, how the credit application process works, right? So step-by-step process, as I had discussed, like did you say bill and how it works kind of thing. The entire process flow, the workflow you can say. Third, most important, how do you segment risk category, right? Now, when I am categorizing risk, based on what parameters I'm categorizing, right? Based on what parameters I am restructuring, right? Say for an example, category of customer, category of customer, category of customer could be FTO, FTB, retail, strategy. So for a line of business, it can also be hire say for an example, commercial vehicle or contractor, captive. So can be a matrix structure like this: hire, contractor, captive with FTU, FTB, retail, strategy, super strategy. Right? Then it becomes a matrix kind of structure. It becomes a matrix kind of structure, right? Now you will determine what is meant by higher FTU for you. What is the basic criteria you need that a hirer with an experience or hirer without an experience, or one who wants to, one who is first time into hiring but has his own residence for at least 2 years, right? It can be a norm, right? You can make a norm like this, right? Now for first time buyer, you can have found like this: who is first time, one who is first time buying, but has his own residence for 2 years and has previous work experience certificates, right? You can make your policies, you can categorize the risk, and based on which you can give the pricing and the quantity of loan that you want to wish to extend for this particular profile, right? Up to this much is clear? Up to this much is clear or not? So this is the way you do risk profiling, right? And you set up the entire, risk categories. Coming about personal guarantees, whether you want to keep personal guarantee or not, that you decide in a credit policy. Now tell me one thing. Say this kind of customer, super strategic. But do you think personal guarantee is needed? But do you think a personal guarantee is needed for super strategic customer? And if needed, whose guarantee you are going to take? Okay, what are the other opinions on this? What are the other opinions on this? Okay. So Abhijit is saying some close friends we can take as guarantee. Okay. What else? What else? So do you need an external friend guarantor or a close friend guarantor for a strategic or super strategic customer? He will say, why should I go and request a friend of mine to extend guarantee for me? Understand the kind of customer we are talking about. What happens if a strategic or super strategic customer is an LLP or a partnership firm or a private limited company or even a proprietorship firm? In all the cases, the guarantee which you prefer to choose are different. How? When it comes to LLP, partnership, or private limited, you try to rope in the shareholder who has more than 51% stake as a guarantor. So when you see the partnership agreement or the LLP agreement, and you see the person who has more than 51% stake in the business, you would prefer to rope him as a guarantor. Yes or no? Yes or no? Guys, can I get a reply, please? But what if the strategic or super strategic customer is a proprietor? हो सकता है, right? It can be a scenario where it's a proprietorship firm having 50 odd vehicles. Super strategic customer. He has not converted it to a LLP, partnership, anything. What about that? What in that case? What in that case? Whom you can take as a guarantor? Boss, his assets are collateral. We are talking about guarantor. We are talking about guarantor, not his assets, not taking the assets as collateral. I am saying giving personal guarantee. Correct. So the first choice would be spouse, his wife or husband. That should be the first choice, or the next choice could be relatives. So the loan companies, they are very clever in this. They always try to rope in the wives of the applicant. You know what is the reason? They always said that, sir, why don't you give extend guarantee of ma'am? You know what? Why? They're very clever. Why does they prefer to take a female as a guarantor? Any idea? The credit policy is made like that. Take spouse as a guarantor or a female guarantor. Why it should not be spouse? If it is a proprietorship firm, why it should not be spouse? That is the safe most game, I'll tell you. I'm into this lending business for last 2 decades. So I'll tell you, running away is the extreme case. Everybody is not Nirav Modi or Vijay Mallya, right? People are scared that his wife will be, roped into a forgery case and his wife can be asked to be present in the court. If there is a legal case, his wife will be. Yes, in home loan, they give discount in interest because you are bringing your wife. So once you are bringing your wife, you will generally not prefer to default because your wife will be asked to go to court when there is a legal dispute. And the finance company, they know and they play with the psychology of the customer. Why they give discount when there is a lady customer? Do you think that they give preference to ladies? No. They're just roping in an additional mitigate so that you don't default in that loan. The moment you default in that loan, your wife will be given someone and asked to be present in the court. That is the reason they give discount. They want your wife to be involved in the deal. And especially when it is a proprietorship firm. Might be it's a strategic, super strategic customer, but it's a proprietorship firm, give the guarantee of your wife. And if you are not married, give the guarantee of your father or mother, rather first mother, not father, mother. Give the guarantee of mother. Right? So personal guarantee, extremely important. Next is joint check agreements. So there could be multiple agreements. Loan agreement comes at the last stage. So before that, on what basis you are funding? Yes, absolutely, Bharat. When guarantor is given, they not only check their assets, but they do check their liabilities, civil reports, everything. If the guarantor is a defaulter, obviously that is not accepted. Even the applicant's loan proposal can get rejected with a defaulter guarantor. Yeah, so where we were discussing about joint check agreements. So when I said joint check agreements, I mean not only the loan agreement, but there are multiple agreements in terms of work order, which shows that there will be future cash flow. So always check those agreements and terms and conditions mentioned in those agreements, especially if you are going for a project financing kind of thing. Do check the termination clause mentioned in the agreement. That under what circumstances the agreement can be treated as null and void and the contract can be terminated, right? Next is preliminary notices, mechanics, lien rights, and security. Now, what are the preliminary notices means? When you are going ahead for a funding, first and foremost thing is you have to check encumbrance on the property. That you can do check by legal check. You check whether the property you are funding or taking as a collateral is free from encumbrance or not. But there is a problem, especially when you are opening a CC account or a inventory financing. So you know what is charge on stock and charge on future stocks? What is charge on stocks and charge on future stocks? Anybody? Charge on stock and charge on future stocks. Write it. Correct. Stock is placed against the facility. So suppose you have a CC limit of 50 lakhs from State Bank of India. Right? You have a CC limit of 50 lakhs from State Bank of India. Right? You see the sanction letter, which states charge created on all the existing stock and future, existing and future stock, debtors and cash flow. Right? What does it mean? What does this statement mean? You will find this kind of statement in sanction letter of CCOD account, especially if it is sanctioned by nationalized banks. What does this mean? Write down, guys. What does this mean? If you don't know, at least say don't know. Okay. What else? So SBI has given them a facility of 50 lakhs. With their business, they are generating cash, generating debtor and cash flow. Right? Once they are generating status and cash flow, that entire future cash flow is also placed to SBI. So in future, whatever be the debtors in the business, the entire debtors of the business will be placed to SBI. Now, the same customer has approached you, you are working with HDFC for another CC limit of 30 lakhs. Ideally, when this condition is imposed, can you create a charge on stock and debtors? Can you create a charge on stock and debtors with this existing condition? We cannot, right? So what is the procedure? The customer has approached you for additional CC limit or an inventory funding limit of 30 lakhs. What is the common procedure? Has anybody worked in this kind of funding facility? Has anybody worked on inventory finance? Okay. So you have to send a letter or you have to notify SBI that the customer has approached you for a funding of 30 lakhs and you will also create a charge on stock subject to an NOC from them. Yeah, right. You can create a pari passu charge also. So you can create a pari passu charge also that's subject to a no objection certificate from them. So here comes the role of preliminary notices. You are giving a notice to the other bank that, sir, this customer, you have given him a sanction, and as per your sanction letter, you have already said that everything will be lent to you, but he has come to me for a funding of 30 lakhs. Whatever raw materials or stocks he purchases from these 30 lakhs, this 30 lakhs raw materials and the debtors arising out of that, it will be pledged to me. I require an NOC from, right? You can send a letter, no? Yes or no? And this letter is being sent by all the CC opening companies, banks, and all the companies who are into inventory funding. They have to mandatorily send the letter and get an NOC from the other party. Acceptance in LC bill discounting. Yeah, so are you referring to that LC which is issued for purchasing raw materials? Deepak, are you referring to that? Okay, so in that case also, you will say that I will create a charge on only those raw materials or stock which is being funded by me, and I require an NOC from you. You got my point? So I'm not creating charge on the entire thing. I am only creating charge on the portion which is being financed by me. So he is suppose procuring 100 crores of raw materials every month, 100 crores of stocks, out of which 30 crore is funded by me. I am creating charge on 30 crores for only those stocks that is being funded by me. That's it. Clear, Deepak? Deepak, Suresh, Vani? Clear, right? Now this is preliminary notices. Next is mechanics lien rights. What is lien rights? What is lien rights? Charge creation. Correct. So you create charge. You create charge on the collateral and other security. So you can create a charge on property, on FD, on shares, right? On any assets, right? The next one is lien policy. What does it mean by lien policy? What do you mean by lien policy? When we talk about lien policy, you make certain policy that the lien has to be created within 30 days of financing. So you create a policy that the charge has to be created within 30 days of financing, right? How do you ensure this? How do you ensure that the charge is created or not? Tell me. Correct. But ROC charge is not applicable for this category: partnership, normal partnership, and proprietorship. There is no question of ROC. So this is something where you have to be a bit cautious, right? You have to take the papers, original and all. Next, if it is LLP or private limited or public limited, then you simply go to MCA and check whether charge is created. Have you seen the charge details in MCA site? Anybody? Anybody who has seen the charge details? Correct. No, in MCA also, it gets reflected. You just name a company. You give me the name of any private limited company, I'll immediately show you if at all MCA site is working. I can immediately show you. Name a company, name a private limited company. See, partnership, proprietorship is slightly different ball game where you need to keep the collateral papers with yourself. You cannot create any charge in the, there is no centralized data system. Name a company, I'll show you the chart. For an example, you go to MCA site. Say master data. Index of charges. Go to index of charges. Say I am giving the name of Infosys. Say Infosys Automation Systems Limited, right? There is a charge created from Oriental Bank of Commerce. The charge amount is 5 lakhs. Vedanta you want to see, right? Vedanta. Vedanta, not Vedanta. Vedanta. Say Vedanta Academy, right? Vedanta Academy, SISNGET. There are two charges registered in the name of HDFC Bank. One is 64 lakhs 32,000, another is 9 lakhs 66,000. For HDFC Bank, lower part. This is the way you can see the charges. And also one important thing, while you do underwrite a case, do match this charge amount along with the CIBIL report. Why it is needed? Why it is important to match this charge amount along with the CIBIL report? Tell me, guys. Why it is important to match these charge amounts along with CIBIL report? Tally and match. Why? Because CIBIL can have three more entries, which is not showing in the charge details. Correct. There are no more liabilities. So once you are taking a loan, obviously it is coming in your CIBIL, but you might not have created a charge for that. You might not have created a charge for that, just to ensure that you have already created charges on all the loans taken. and where you are supposed to create charges, you double check the CIBIL and match those figures along with the charge created, right? This is about your lien policy. So you make it a policy that the charge details needs to be checked and frequently reviewed, especially for those where it is available in open source, right? The collection policy, very important policy. So in the credit policy, you have to make a collection policy. What is that collection policy? What could be the different aspects of collection policy? What could be different aspects of collection policy? Write down, please. हाँ भारत जी बोलिए ना. So collection agency is one part. So one major important thing is to prevent early delinquency is awareness calling. First step, awareness calling before, rather before awareness calling before disbursement. To confirm the following things. One is loan amount. Next is ROI. Third is moratorium. Fourth is tenor. Fifth is first EMI. Eighth and sixth and most important is EMI amount. Right? First, awareness call for the customer so that no problem, no gap in understanding crops up. So that no gap in understanding crops up. Right? There has to be no gap in understanding. This is the first thing. Second, awareness calling is before the first EMI gets hit. Right? So you must have either manual calling or you must have a automated calling system, a TVR calling kind of system, where there the customer should be receiving at least multiple calls, at least 3 calls, starting from 1 week before the due date. That, sir, this is your due date when the first EMI is going to get hit. Please make sure that your account is adequately funded. Right? So these are basically proactive methods of collection. Proactive methods of collection. The first one eliminates any kind of misunderstanding, any kinds of future dispute between the loan granting company and the customer. And the second one ensures two things. What are those two things? One, whether the customer has received repayment schedule or not. Second, whether there is any miscommitment or not. Correct me if I'm wrong. And correct me if I'm wrong. Am I correct in this aspect? Right. Next is FLDG. What is FLDG? What is FLDG? What first loss? What is DG? First loss default guarantee. What is the concept? What is the concept of first loss default guarantee? Guys, please write down. It should not be a one-way communication. I'm telling you time and again. I don't mind. I'll just simply keep on blabbering till 12:30, and ultimately that will be of no use actually if you do not participate in the discussion. Say loss is, yeah. So not only in co-lending, co-lending obviously, plus even on lending, you can take FLDG. So you can take, even in project finance, we take FD as FLDG, right? Then the next option is escrow account. Escrow account. Who are the participants in escrow account? Who are the participants in escrow account? Who are the participants in escrow account? The participants are the borrower, lender, and and borrower's bank where payment is received from principal and the principal itself. Right? So one is 1, 2, 3, and 4. These are the 4 participants in a escrow account. Am I correct? Now the next one is TRA account, that is trust and retention account. What is the difference between an escrow account and a trust TRA account? What is the basic difference? No, cash flow is always, even from TRA account, the borrower cannot take a single money without approval of the lender. No. Out of these 4 principles, only 3 principles are there in TRA account. Why? Say the principal is NHAI, National Highway Authority of India. They have a, high-headed kind of principle. They said that I will not sign any escrow agreement. I will not get into in this. Then what happens? The lender asks NHAI, sir, you give a letter that you will give money to this person in this particular account only. Say the account is Axis Bank. In this account number, Axis Bank, you will render the money. That letter is taken from the principal, like NHAI or any government. With that letter, an agreement takes place between the borrower, lender, and the borrower's bank that all the payment as per the letter from the principal will be coming to the borrower's bank, this particular bank only, and not a single payment will go out of this bank without lender's approval. So I was into project finance. Practically, I'm saying you, when I was in Reliance, I was into project finance. So even for paying the raw materials for salary, the borrowers used to take approval from us that we have to pay this much amount as salary. So this is my cash flow. Can I take money from the TRA account? So we used to approve, check the bills, and then approve, and then only they could, take money from the account. This is what is TRA account. The same process is escrow. Only thing is that in escrow, the principal himself is also involved in the escrow agreement. This is a basic difference between an escrow and TRA account. So while formulating credit policy, you take into account of these collection policies. That this is how I mitigate, right? Coming to litigation policy and procedures, how do you formulate in credit policy the litigation policies and procedures? How do we do that? How do we do that? So have you seen certain documentations like DPN, demand promissory note, that is DPN. One second, guys. So demand promissory note is something. Demand promissory note is something which is a legal paper. You make it mandatory in the credit policy that your agreement must have a DPN. Your agreement must have this clause. So when you formulate a credit policy, you formulate documentations and loan agreement policy as well to mitigate any kind of future delinquency, right? Yes, Bharat, you must have a strong legal team. You must have a strong legal team, right? So this is what we talk about litigation procedures and policy. Now it is managing and oversight. Now, when we talk about managing and oversight, it comes to your, certain aspects like, say for an example, periodic review of portfolio, periodic review of sectors and region, right? So when you talk about sectors, it's a broad analysis of the overall sector coming in terms of geopolitical risk, in terms of economic fundamentals. A lot of things are there. So what is the example of mission statement? The credit department is responsible for maintaining a high quality of accounts receivable. High quality, not high quantity. Remember, high quality of accounts receivable. When I talk about high quality of account receivables, so when I talk about high quality of accounts receivables, it means I'm coming to you, Tanumai. Just give me some time. Let me complete this one. Okay. So high quality of accounts receivable means one who pays in time. It is our policy to provide credit terms to all potential applicants. The credit department will attempt to screen out the customer that represents significant risk and extend open terms to all. So when I talk about oversight, it means scrutinizing, keeping an open eye. So when I talk about open eye, that means an open eye on the profile, the sector, policies, the portfolio, entire thing. Is that clear to you, Tanumay? Right? So this is a typical credit approval process, slightly, in terms of system oriented. So one is process data. Once you gather data, you process the data and then you evaluate risk. So in the first part, you evaluate risk and then you send it and you start credit approval. Now the credit approval with the risk level analysis, it could have two outcomes. One is high risk, another is low risk. So if it is high risk, you send what is called money. That means you lend it and it goes to end. When it is high risk, you can reject and send a rejection mail. Or when it is high risk, you can reassess and then you approve with certain mitigates and then you come to an end. This is the overall procedure, right? Any problem in understanding this? Any problem in understanding this? Oh, this is actually, when you send data, like it is made in terms of system when there is an automated credit flow. So you are sending data, which is in string. String is a data type. So this is mainly for automated credit system. No, it's not like a pre-approved loan segment, but definitely a preset credit policy, which is automated. Okay. Next, we will talk a bit about forward contract. So we all know a forward contract is an agreement to buy or sell a specified asset at a certain time in future for a specified price agreed upon at a time of entering into the contract. So actual exchange of cash and assets takes place at a future date. There's a commitment that I will be purchasing that product on that particular date at this particular rate, right? Next is price at which exchange will take place is determined at the current time. So it also again depends on the current exchange price, right? What would be the price for that particular commodity on that date? Mainly, we have seen forward contract even in equity market and also on the commodity market, right? This is a typical flow of a forward contract. Say we have given some example as well. So when a farmer makes an agreement to sell 5 kilo of wheat at 40 per kg after 3 months to a customer. 3 months later, what happens? Farmer gets 200 rupees because it was a pre-agreed price, and he gives 5 kg of wheat to the customer, right? He gives 5 kg of wheat to the customer, right? Now, there is another term called future contracts. And what is the difference between future and forward contracts? I've tried to put it in an easy way. So when I talk about meaning of a forward contract, it is an agreement entered into by two parties to trade assets in future at an agreed upon rate. And in future contract, an agreement where parties agree to sell fixed assets at a fixed price in the future. Form is unique contract. Future is a standard contract. Now settlement happens in forward contract at upon maturity. Future contract can be executed at any point of time. When it comes to regulations, that who is regulating forward contract? Yes, nobody is regulating forward contract, but definitely future contract is getting regulated by stock exchange. Future contract is getting regulated by exchange, right? Trading can happen over the counter for forward contract. For future contract, it is an organized stock exchange platform or a commodity exchange platform where the trading can take place. The basic difference between future and forward contract, right? So in a future, it is exchange of clearing corporation. Okay. So can you elaborate? Yeah, so that's what is being mentioned. Like it is regulated by an exchange, and in forward, there is no regulation. It is not regulated by any exchange or anything. It is totally takes place over the counter. Yes, absolutely, Kunal. Okay. So there is a small case on forward contract. Just quickly go through this. Yes, they are different, but once you are trading in a platform, absolutely it is different. but then you are much more secured because it is being regulated. Why we say that bitcoins are quite risky? Because those are not regulated by anybody. And even you don't have a centralized data repository from where you can, you can retrieve your password, you can retrieve your credentials, right? That is the reason bitcoins are quite risky, because the concept of blockchain is like that only. You are right. But to some extent, had it been, had a forward contract been getting executed in a regulated platform, in an exchange, the risk could have much lesser, right? Banks have started doing what? Okay. So I think, Tanumay, this is the Treasury Department who does this. So one is investment bank, and I think Treasury also. Treasury also does that, right, Praveen? Treasury mainly, they are into all these activities, so far I know. Treasury guys are trained for this, and they keep on watching the market every day. Even the international market, they keep a look on the forex. Okay, so what happens? The agreement was selling 4.3 per bushel in 6 months. Now, if the contract price, it is like, in case the ongoing price in the market is 5, still the producer has to sell it at 4.3, so he incurs loss at 70.70 per bushel. And if it is lower, say around 3.5, then the producer is gaining at 0.80 per bushel. So this is forward contract. I'm not talking about future contract, Kunal. The example which I have given is forward contract. That's okay, not an issue. There is certain risk of forward contracts which is being mentioned. So when you say physical settled or cash settled means what? When the selling takes place, right? When the selling takes place, the commitment was to sell the commodity at that rate, right? Yes, it must happen. It must happen. Right. So it can be physical delivery also. It can be physical delivery also. See, first we have to understand one thing. When we talk about forward contract, so it is totally unorganized. I just say that on particular day, I will be executing this trade. That's it. Probably I do an anticipation, fair enough, that even if the rate goes low, I'll be getting 4.3. That is an anticipation. So what you are referring to, probably you are talking about future contract. It is mostly physical delivery, but not necessary. Correct. It depends on the agreement between the parties. That's why. Right. Now let us discuss some risk of the forward contract. So first of all, it is unorganized and it is very difficult to estimate the size of the buyer and seller in the market. The large size and unregulated nature of forward contracts mean that it may be susceptible to cascading series of defaults in the worst case scenario. Absolutely. Because there is no regulation, no control, it can lead to a lot of defaults. Another risk that arises from the non-standard nature of forward contracts is that they are only settled on the settlement date and are not marked to market like futures. What if the forward rate specified in the contract diverges widely from the spot rate? So when we say that 5 and 4.3, probably there is a difference of 0.70. But if it goes to 8 rupees, then 8 and 4.3, that is around 3.7, which is almost 100 price of 100% of the agreement value. What if that kind of divergence is there? Then it makes the situation extremely critical. Okay. Okay. So that's a recent development, I guess, Praveen, right? That's a recent development, I guess, right? But what I knew that might be for the big banks, but for the small banks, for the small entities, like they probably still now are not following that M2M. Those who are into this. See, big banks has an advantage that they have qualified people already in the treasury department who can monitor the things. That's a quite important factor. Another thing is that suppose your accountant, like I am having a small business for an example, and my accountant is, like using the idle money, that makes a difference. So when it's a small company owner, I have some idle money, I have made an account. I mean, accountant is the only treasury guy. then the scenario becomes slightly different actually. Okay. In this case, the financial institutions that originated the forward contract is exposed to greater degree of risk in case of default or non-settlement by the client. And then if the contract are marked to market regulated. Okay. Next is we are going to discuss about hedge, an investment that is made with intention of reducing the risk of adverse price movements in the assets. So we all know what is hedging. Like we all have, I think we talked about the currency hedging, forex hedging also. So we pay an extra premium to fix the price. So for an example, say I want to fix the price at 4.3, that even if there is a downward or an, there is an upward revision in the price, in the spot price is slightly greater than or lower, then also I will get the commodity or the stock at 4.3 only. So that is the purpose of hedging, and for which we pay a bit of premium, right? So this is how typically hedge works. So investor witness unforeseen price fluctuation in a security, holds a position in one financial market, or takes a position in another financial market. If one asset loses value, profit from another asset can nullify or reduce risk associated with the investment. So this is one way of hedging, right? So you diversify your fund across all the markets. So you play in NSE, you play in London Stock Exchange, you play in BSE, you play in commodity, you play in equity, you play in something else. right? And you diversify the risk. This is one way of hedging, that is you counter the risk. The second way of hedging is you pay a premium and you fix the price. You pay a premium and you fix the price. Okay, so that is other way of hedging. This is a typical example of hedging, which is quite similar to the 4.3 per bushels. So just have a look. A farmer prepares a wheat crop. Farmer sets a target price for the harvest. Farmer and baker considers price fluctuation. Farmer and baker use a hedge to reduce the risk. The hedge manages the risk. So again, the same thing, that even if the price is 5 rupees, the baker said, even if the spot price is 5 rupees, I will give you 4.5 rupees. And the producer says that even if the spot price is 4 rupees or $4, I will be getting 4.5. That's the agreement. I hedge it and I pay a premium for that. Kind of that, right? Now, generally, who should hedge? Any investor operating in a short-term investment generally goes for hedging. Long-term investors who block their money for a long term is not worried about short-term market fluctuations. So it is mainly for the short-term investors who should hedge. Long-term, generally, your fluctuation gets countered with time. So exporters and importers who has to deal in currency, forex, they do hedge. Currency traders, commodity traders, international investors, short-term private equity players, and short-term lenders operating in international lending. So suppose you are lending to a firm who is based out of Dubai. You are lending to a firm who is based out of USA. At that times, that too also on a short-term basis. That times you should ideally go for a hedging, right? So that's all. Any query, any feedback for this session? That's all, guys, for today. Anything for me? Thank you so much. Thanks, guys. Have a great Sunday. Thanks. Take care. Thank you so much. Thanks. Thanks, Manish. Thanks, everyone. Thanks. Bye. Bye. Have a great Sunday.